Hello, everyone, and welcome to the last day of July, and of course, another episode of the Market Snapshot series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So first of all, I would like to begin with a mic test. So if you can hear me clearly, you can just type hi on the live comment section, and these will confirm that everything is working just fine. Awesome. So last week, we had quite a number of things going on in the markets. One of them was interest rates in the US and of course, interest rates in the Eurozone, as well as in Japan. So the key highlight for the week was that the Fed raised interest rates by 25 basis points, which basically took interest rates in the US to a 21-year high. And of course, rates hit 5.5%. And then the markets is pricing in the potential that the Fed will not implement another rate hike. So hello, Irene, Paul, Arnold, Jesse, Prince, Doreen, and Kenneth. Thank you guys for joining the session. Happy to have you on this session. So besides the two central banks raising interest rates by 25 basis points, we also had a major policy shift happening in Japan, where the Bank of Japan decided to expand the yield curve control program to a flexible hold from the previous limit of 0.5% to 1% on the 10-year bonds. So this basically means that there's more room to wiggle for the Japanese 10-year bonds, and this caused quite some volatility on Friday. And last point was about the PCE price index coming in lower than expected, basically showing that inflation is moving in line with the expectations. And this further strengthens the belief that the Fed may no longer continue hiking interest rates. So this week, we have quite a number of things that we're expecting. So I'll be starting with the economic calendar. So just a moment. So here we have the economic calendar. We started with quite a number of news. Preliminary industrial production in Japan is improving to 2% from the previous reading, which was negative 2.2%, but also it's missed expectations of 2.5%. So retail sales in Japan also improved 5.9% from a previous reading of 5.8, and this was better than expectations. MI inflation gauge in Australia came in at 0.8%, which is slightly higher than the previous reading of 0.1%, meaning that inflation could be on the rise in Australia. ANZ business confidence survey in New Zealand came in at negative 13.1, still pessimistic, but an improvement from the previous reading. Then we had private sector credit from Australia, which slowed down to 0.2%. This is naturally expected, especially when interest rates continue rising. Sorry for that. Then we have manufacturing PMI, which came in at 49.3 from the previous reading of 49.0, showing that Chinese manufacturing is improving. And of course, for services sector came in at 51.5, still expansionary, but lower than expectation, and of course, lower than the previous reading. So going on for the rest of the day, I don't think we have any major news. Consumer confidence in Japan slightly improved to 37.1. Housing starts really slowed down, negative 4.8%. European import prices, negative 1.6%. And of course, retail sales in Germany were down negative 0.8%. So the only major news focused on for the rest of the day will be this European CPI flash estimate, which is estimated to have slowed down to 5.3% on the year, compared to the previous reading of 5.5%. So remember, at the ECB meeting last week, Christine Lagarde basically mentioned that they are moving their policy to data-dependent approach. So depending on the data that they see from the Eurozone, they'll use that to make a decision on their next meeting. So in this case, if we happen to see inflation slowing down in the Eurozone, then it will be more confidence that the ECB will be less aggressive. But then if inflation comes in hotter than expected, then in that case, we expect the ECB to be more aggressive. So there is a potential that this could cause some volatility in euro dollar pairs, and of course, European indices such as the Euro stocks, the German DAX, and so on. So this will be pretty much important at 12 p.m. So if you have any questions arising from the presentation, feel free to type them in the comment section, and I'll be responding to that right away. So going forward for the rest of the week, I know tomorrow very early at 7:30 a.m., we will be having an interest rate decision by the Reserve Bank of Australia, where it's expected to hike interest rates by 25 basis points, eventually moving the interest rates from 4.1% to 4.35%. So this, of course, will be expected to cause some good volatility in Australian dollar pairs. And of course, it could present some nice trading opportunities. So on the US front, we'll be looking at the ISM manufacturing PMI as well as JOLTS job openings. So remember, today being the last day of the month, also means that this week digs into the first week of August. And of course, every first Friday of the month, we get to see US jobs data, or what we call the non-farm payrolls. So the non-farm payrolls happens on every first Friday of the month. And before it happens, there's quite a number of data points that will come through. And this helps us to shape the perspective of the job market. So from the JOLTS job openings on Tuesday, it will be followed through by the ADP non-farm payrolls on Wednesday. Then on Thursday, we won't be having much, just the unemployment claims. And then on Friday, this is when we get the official data. That is the US non-farm payrolls, where we're expecting that the US created 200,000 jobs in the month of June, and in the month of July. And if the job market remains tighter, means that the Fed may have to do more. But if unemployment rate is rising and non-farm employment change is slowing, then this will be consistent with the Fed's expectations. In that case, we might not expect the Fed to be more aggressive. So that's a brief highlight for the week. And of course, we have the big day for the Bank of England, where it's expected to hike interest rates by 25 basis points on Thursday, eventually moving interest rates from 5% to 5.25%. This will be quite volatile for the UK. So that's the highlight for the week. And of course, now it's time that we start looking at the charts, look at what happened and what we're expecting to see going forward. So from the dollar index, we can see the big jump on Thursday last week, then some pullback on Friday, and then today it's attempting to make some moves, and I don't see much happening. Even if you go to a small time frame, you can see the candlesticks are relatively smaller for the dollar index. So we don't have much fueling the markets today. So we could be expecting previous trends to be continuing. So for the pound USD, we had a sharp drop happening on the news on Thursday, but then on Friday made with some recovery, and I expect this form of recovery to continue at some point. So while I expect this to continue from a smaller time frame, this is the 15 minutes chart, you can see the market is just ranging, it's just moving sideways. So this is usually very important. It basically helps you to identify a breakout. So when you monitor these two trend lines, you'll know the direction that the market is taking. So if there's a breakout to the upper side, then it creates an opportunity for a buy. If it's to the lower side, then an opportunity for a short selling position. So I think it's a similar story for most other charts. So if you look at Euro USD, made quite a rally, trying to recover from the previous move on Thursday. And now if you look at today's price action and you go to the 15 minutes chart, you can see what was happening here. So we are having a market that was following this path, and now we just have a breakout that has just happened. And there's a good chance we'll be seeing some more upside happening here. So you can see from this area, there's some form of momentum getting into these markets. So the momentum is happening along this area, and there's a good chance we'll be seeing a continuation pattern where the euro continues to recover to the dollar. From the data that we saw last week, it was largely conclusive that there's a good chance we'll be seeing a soft landing in the US. And by a soft landing, it basically means that the US may successfully fight inflation without causing a recession within the economy. So while that remains a possibility, then this basically creates the necessary momentum where these pairs could start recovering against the dollar. So as for USD/JPY, so the big announcement, you can see there was this volatility happening on Friday, both ways. This is when we have the Bank of Japan on Friday. But then towards the end of the day, the Japanese yen started losing, and this remains a continuation. So I remember telling you guys some time back that after all this pullback, we expect that the dollar will start to strengthen again against the Japanese yen, and this has remained the case, especially since Friday. So I think there's a very high likelihood that the Japanese yen will continue losing to the dollar. Of course, if you look at recent highs, then there's a good chance that we'll be seeing a burst of momentum after breaking this particular resistance here. So there is a good chance we will be seeing some further upside, perhaps towards the previous high area here. And this is around 143 Japanese yen for a dollar. So there is a good chance we'll be seeing this form of continuation happening here. So as for USD CAD, you can see that we already broke outside this. So the dollar was majorly trading sideways for quite a number of weeks. Eventually broke to the upper side, but has really struggled to break above that. So now the likelihood is that the market may come back downwards. So if the dollar remains weak in the markets, then the Canadian dollar could strengthen back. And we see this kind of continuation happening where the market could come back and start retesting these zones. So it's an area of wait and see. I don't see much happening here. So all this seems like a very noisy market. And of course, remember on Friday, when you have the non-farm payrolls, we also be having the jobs data coming from Canada. So we also be seeing some good volatility in Canadian dollar pairs. So as for gold, there was a big drop on Thursday last week. But then on Friday, we made some good recovery. I would say this is like 50% recovery from the original move. And now today it started by weakening, and now it seems like we are finding some pretty good support around 1953. So 1953 is a level we have been monitoring for quite a period now, and it has been quite strong in holding this level. So right now, if you go to a smaller time frame, this is the 15 minutes chart, you can see the number of times the market has been flirting with this level of 1953. So if it happens to hold as the key level support, then there's a good chance we'll be seeing some higher gold prices for the day. For Australian dollar, you can see it's making an impressive recovery. But as I've mentioned, tomorrow very in the morning, we have a decision that we're expecting from the Reserve Bank of Australia. So you can either choose to participate in this one or wait it out until there is an announcement from the Reserve Bank of Australia. So we can already see that this was the prevailing trend. The market slightly broke towards the lower side on Friday, but now it's back inside the pattern. So there is a good chance that if technical patterns prevail, then we'll be seeing some further upside. And of course, the immediate target could be the previous low here. And this is around 0.67249. So this is an interesting area to watch for the day. So as for US equity indices, they remain strong. So despite the big sell-off that happened on Thursday, Friday, we managed to see some good recovery. And the original thesis remains the same. We still expect that the NASDAQ index will continue to rally higher. So today, I expect that the price will start to retest the $15,904 level. So some further upside momentum is expected. Same case for the Dow. And of course, the same case for the US 500. I expect some further upside momentum. So after the big sell-off on Thursday, Friday recovery, and today, I expect the market to complete the journey. So as for Brent oil, it remains strong. And of course, with today's morning news of Chinese recovery in manufacturing, basically boosted prices, and I expect to continue some further momentum. So after the market broke this triangle last week, you can see the break happened here. The market went back, retested the area, retested again before pushing higher. And today, you can see after the early morning sell-off, we have already recovered. We are back to last week's high, and we could be seeing some further upside momentum happening in Brent oil prices. So if you zoom out, you'll notice that the last time the market was trading at this area was all the way back in April this year. And if we keep seeing this upside momentum, then there's a key important level that has been tested 3 times. So if I zoom out, you'll notice this area here, and this area, and this area remains very strong resistance. So there is a good chance we'll be seeing the price of Brent oil cruising higher to $86.6 per barrel. So let me check on the comment section to see if there's any questions. So if the investors are pricing in normal rate hikes from the Fed, why is the dollar strengthening? So the dollar was strengthening last week because of a host of strong economic news that was basically signaling that the Fed may go for another rate hike. But then the data that came in on Friday changed the entire perspective. And now the markets are expecting that inflation is quite consistent with Fed's expectations. And now, as we price this in, then we are recovering from the move that happened on Thursday. So the move happened on Thursday, and then on Friday, the perspective changed. That's why we are seeing a dollar that is quite weak, slightly weak than what we saw on Thursday last week. Good morning, Ian Koech, Charles Mukua, and DNC. What is your expectations on interest rates and economy trade-off in the Eurozone? Germany appears to be in recession and mortgage market in distress. Yes, Germany is in a recession, and housing across board is forming or brewing a crisis on its own. So while the Fed and the ECB were able to create emergency liquidity to save the banks, they were not able to do so for the housing sector. So cracks are continuing to emerge in the housing sector. If I were you, I would not touch any stock in the housing sector. They are currently in a huge crisis because higher interest rates basically lead to a potential where people could default on their mortgages. And with the rate of defaults rising, then it becomes a crisis on its own. So, well, for the Eurozone, I expect the European economy to be in a recession. And I expect inflation to start rising again, especially considering what we are seeing in oil prices. So we have seen oil prices have been on an upwards trajectory, and the OPEC countries are just cutting production. So if oil prices move on higher, then it basically means that we could be seeing other product prices going higher, and this could become a challenge, especially getting inflation back to the 2% target. So as a result, I expect the ECB to be tightening policy further. So we could be seeing European interest rates rallying all the way up to 5%, and UK interest rates could rally to 6%. So with this in mind, we know that higher interest rates are positive for the currency. So we could be seeing the UK pound and of course the euro being really strong for the second part of the year. Gold made a breakout on the rising wedge on 1 hour time frame. Do you expect a downward move or we use price action? So let me check on that. So there's a question on gold, H1, where is the rising wedge? So for me, what I'm seeing overall is gold moving down along this particular trend line for a couple of days, and then getting some very strong support along this area. So you can see this bottom here happen to be the same bottom here. And if I remove all this other noise, then you can see it's a market that was on course to complete this pattern here, which looked like a cup and perhaps a cup and a handle. But then out of the news that came in on Thursday, there was a big jump downwards, which was exhausted at this particular support. And then Friday, the market makes an impressive recovery. So in this case, I expect the market to continue recovering. And after the pullback that we have seen this morning along this area, if the 1953 level holds and we see evidence of bullish momentum, then it might mean we go for another leg upwards. So if there's no evidence of that, then the market goes back to retest the bottom around 1946 level. So that's why I said in this area, I would be monitoring just these two regions here to see what happens with the price. I would really want to see some evidence of bullish or bearish entry. And that would mean just one single candlestick strongly breaking to either direction. This could be breaking towards the upper side or breaking towards the lower side. So if this level holds, you can see the number of tails along this area where the market is clearly unable to break below 1953. So if I see evidence of a jump upwards, then that would mean there's a likelihood that the price keeps on moving higher. Kindly explain the correlation between US oil and Brent oil. US oil and Brent oil move in tandem. They move relatively the same. So if there's a big spike in Brent oil, you'll almost certainly see a similar spike happening in US oil. So the only difference is the pricing. Remember, one of them is usually a couple of dollars higher. So if you look at UK oil and you look at the analysis I made here, where price is trading at $84.4 per barrel. If you go to US oil, it's the same thing. The only difference is the price. So for the US, it's at 80.5. So there's a difference of about $4, but the momentum is expected to be relatively the same. Even if I zoom out here, you'll notice the target now for the US oil is a couple of dollars higher, around 83. So while one of them is expected to hit 86, then the other one goes to 83. So the correlation is almost the same. That's why I normally just analyze one and expect if you're trading the other, you'll have a similar price action. What is the general state of Japan economy? Is it improving? Japan is in a kind of a situation where things are really working out, especially for the manufacturing sector. If you look at the Nikkei 225 index, it has made quite a good first half of the year. So things in Japan are not that bad. The only bad thing in Japan is the investors in bonds, because the Bank of Japan has been controlling yields. So limiting yields to plus or minus 0.5% and now plus or minus 1%. Basically means that you don't get to earn much from investing in bonds. So this has basically forced people to go into risky assets, which basically involves equities and basically stimulate the economy. So with the yield curve control program, it has really been strengthening business in Japan, but the overall effect is the weakening of the currency. So the currency has been quite weakening against other currencies. And since Japan is a net exporter, they depend on exporting their products. This has created some really good demand for the economy, but it doesn't just come like that. It also comes with inflation. So now inflation is becoming a bigger problem for Japan, and of course, the currency devaluation. So while their currency is suffering, the overall view of the economy is pretty stable and strong. So we expect the Eurozone to get into stagflation. Would high interest rates worsen the already critical situation? Yes. The fact that the ECB president wasn't committing to further rate hikes is because she understands that higher interest rates are bound to cause more cracks. And the tricky part with the Eurozone is that if you make a decision, let's say to raise interest rates, it doesn't affect the entire economy uniformly, because there are countries that are pretty strong, where others are really weak. So 25 basis point hike on Eurozone interest rates may not affect Germany the same way it affects a company like Italy and Spain. So in this case, it might cause more problems in the economy. So that's why the projection for lowering inflation rates back to the 2% target are being moved further away. So from her recent reading, it was around 2024 through to 2025. So they don't expect to win against inflation anytime soon. And this is causing a bet that if they keep on tightening, then it could keep on is the USD Fed chair that the US monetary policy is shifting to data-dependent approach. So what this means is that for us as forex traders, we are exposed to the whims of every news that the Fed is also looking at. So if Fed is watching the PCE price index, we know they're going to use that data point to make a decision about interest rates. So if it comes in lower than expected, we know that this basically pushes the Fed decision towards an interest rate pause. And in that case, it's negative for the dollar. So if there's a host of strong economic news, then that's negative for the Fed. In that case, it basically strengthens the dollar. So we keep on weighing every data point that come in based on what the Fed might do with it. So as we look at the NFP this week, if the job market is really strong, that's a problem for the Fed, and they might have to continue tightening policy. If job market comes in very weak, unemployment rate increases, that's consistent with what the Fed is looking to achieve. Remember, they're looking to achieve at least 5% unemployment rate. So if unemployment is rising and the number of new jobs created is going down, then in that case, we could be seeing the Fed soften their approach in the markets, and that would be quite negative for the dollar and of course positive for equities. So that's the way we are looking at this data going forward. So when you think of Euro USD, I think we'll be reacting based on a data-dependent approach for both economies. So every data point that comes in, either for the euro or for the dollar, then we look at how the ECB might react, and of course, how the Fed might react to that data. So one last question as we approach the end of the presentation. According to you, what's the most important role of central banks, stable prices or full maximum employment? Stable prices is the number one mandate. Maximum employment is something that they try to achieve, especially when the economy is slowing down. But most important thing is basically the stabilization of prices. So controlling inflation is one of the biggest challenges that central banks have to face, and that's their number one mandate. So let's hit the like button, team. Yes, thank you guys. Thank you for liking the session. Make sure to subscribe to the channel, and of course, share these videos with other traders out there, especially the ones that are struggling to understand how these things work. And bit by bit, we get to build the entire team. So as we end the presentation, these movements that seem to be happening sideways, eventually they may go for a break. And when that happens, this will represent the right opportunities for us to make market entries. So for instance, if we see the dollar index being really strong, then we know currency pairs like the pound USD might break downwards, Euro USD might break downwards. But then if it's weaker, then we could be seeing both pairs breaking upwards. So it's only being patient and waiting for the evidence, candlesticks showing you that this is the direction you are taking. And of course, as always, you trade what you see, not what you think. But for USD JPY, I think it's pretty much straightforward. There's a good chance we'll be seeing higher prices, and 143 level is quite close, and we could be seeing that happening within the day. So thank you guys. See you on the next session tomorrow at the same exact time, 11 a.m.